Good morning, everyone. What is up? Happy Thursday, guys. Good morning, good morning. Glad you all could join me this fine Thursday. How's everyone feeling? Day 3. It's early, so here's the day that kind of tests the ability to whatever you want to call it. Handle the early morning. If you guys can make it to today, you'll be just fine. Today's the hardest day to wake up, day 3. Happy Masters weekend indeed. Special time of year, absolutely. Stock market should be closed all week in honor of the Masters. I don't even know what we're doing here. I should be prepping for the Masters right now. That's for sure one of the special places on planet Earth. I got to go a couple years back, and wow, what a special place! What a special place! If anyone's been there, it is unlike anywhere else on planet Earth. Pretty cool. Pretty cool. God, I'm excited to get into today. We're going to be going over lots of really good stuff. Starting to get into where it's fun, learning, elements of the strategies, elements of what we're looking at. God, it's going to be fun. It is going to be fun. Morning, guys. Morning, morning. Everyone hear me okay? I'm assuming. Thumbs up, thumbs up. Hope so. Lovely. Just lovely. As per usual, we're going to wait till 6:18. That gives us about 30 seconds starting right now. Excited to be here with you guys. Excited to be going over everything. Welcome to anyone who is joining for the first week free of this mastermind as well, whether you took part in a challenge or were invited to do so. Very happy to have you here. We're going to dive into some really good stuff today and further our understanding of what our goals are as day traders. All right, guys, it is now officially, according to the Thinkorswim clock, 6:18 a.m. So welcome, welcome to the first Thursday of the Mastermind, where we will be going over a little more of the genetic DNA makeup of an option contract and what options are, but then we're diving into candlesticks, support and resistance, trends, and it's going to be a lot of fun. So I appreciate you guys being here. I hope you guys have fun in these sessions, and most importantly, I hope that you learn as well. I did Cowtop's an amazing Airbnb just outside of Bandon Dunes I've ever been. Ivan, not only have I been to Bandon Dunes, one of my good friends is the head pro at Pacific Dunes, and this July I am staying on property in Bandon, and we're doing like a 12-man Ryder Cup style 4-day playing 36 holes a day at Bandon Dunes. So that is going to be epic. Very cool that you did some work out there. I love it out there. All right, guys. Well, with that being said, I would love to sit here and talk about golf and the Masters and everything else, but should we learn some stuff? Should we learn about day trading? Why not? Let's get after it. So yesterday, here's what we learned, right? Yesterday we talked about what the stock market is and what stock options are, right? And we really made the comparison to sports. And if you were owning a team, right, you owned a part of the Utah Jazz, you owned a part of the San Francisco 49ers, you do better when they do better. Trading options is you essentially betting on the game, right? Or betting on how well they're going to do in the month of March or how well they're going to do over the year. And so you can make money whether they lose or whether they succeed, right? Few things to keep in mind is as we trade options, we are in and out of the trades in the exact same day. So it truly is in and out. We are never holding long term. That is a different form of investing, and that's what most people think when they think of the stock market. So just keep that in mind as we get into today's trading. So what we will continue to talk about today is the option contracts themselves. So we showed you yesterday when I pull up this little chart here. These are the contracts that you can buy, right? So imagine again, we're looking at SPY, or let's say we're looking at Google. Yeah, sure. Let's look at Google. We all know Google, right? So if we look at Google and we look at the contract expiration date, and again, we always, as day traders, we are always trading the same week expiration date contracts. So for you guys, right, there are different tickers, and a ticker is just the abbreviated name for the stock, right? So Google is GOOGL, Tesla, TSLA, Apple AAPL, right? So you don't just type out the actual name. That is what a ticker is called. So some tickers have, as you can see, contracts that expire every other day. There's a few like SPY that have contracts that expire every single day. But as day traders and as you guys are learning, I want you to be trading always contracts that expire that week. So we always are going to look at Friday's expiration. Okay, so Friday would be the 10th. And so whether you are trading on Monday of this week, Tuesday, Wednesday, Thursday, Friday, doesn't matter. You are going to select the contracts from the weekly expiration contract, which means you just find the contract that expires on Friday. Makes sense? Reason for is they move and they move fast, but they're not going to move as fast as some of those daily ones. And we'll get to that. But for now, I want you guys always trading the weekly expiration contracts. So let's talk about nope, James, always Friday, okay? Always Friday right now, right? When we're learning, right? I don't want anyone trading same day expiration contracts, but you don't need to worry about that because you guys shouldn't be trading right now anyway. All right, so here we go. Let's talk about what an option contract is, okay? There's a few different things that you need to know about an option contract, okay? So you're going to hear terms, and this is what they mean. The expiration date, okay? Expiration date is what you see right here. So if you go to the option chain, or where it is that you want to select your contract, right? So let's say we're watching Google over here. You say, hey, I think price is going to go up. So if we think price is going to go up, do we want to find a call contract or a put contract? What do you guys think from what we learned? We believe it's going to go up. Should we find a call or a put contract? Call. You got it. So we go over to the trade tab here and you type in, right, whichever ticker we're looking at. So it's like, cool, Google, we want to find some calls. Let's look for it. So you always are going to find the contract expiration date that is the Friday of the week you're on. Okay, that's the rule. Okay, Friday of the week you're on. We don't need to worry about all of these. We are always going to select the contract expiration date of that Friday from the week. So once you click on it, it opens up the option chain. Okay, so now once you're in the option chain, there's a few things you need to know. The strike price, okay, this is the name of the contract. Okay, so if I'm telling you guys, hey, we want to buy the 315 calls, okay, well the name of an option contract is called the strike price, and you can see these are the numbers right here. So you got the expiration date and then the strike price, okay. So if we went down to the 315 calls, right, so you'd see 315, and then the calls, okay, are over here on the left, and the puts are over here on the right. So you go 315. Go over to the left. This right here is the 315 call. Okay. If I said the 310 puts, right? You go down 310. That's the name of the contract. And then the puts over here. Last example, let's say I wanted to say the 325 calls. We'd go down to 325 because that's the name of the contract, the strike price, 325 calls. Okay. So you've got the strike price and the expiration date. We know those. And then you have what's called the option premium. And the premium is the cost. Okay, the premium is the cost. Now, I don't make the rules. I'm just relaying them to you. So I'm going to explain what the premium is. Okay, the cost of a contract is the difference between the bid and the ask right here. It's really, really simple. Okay, so let's say we're looking at the 317.5 calls. Okay, so 317.5. We go over the calls. You see the bid is 290. The ask is 310. So the middle of those two is what? $3. Okay. So that's the premium. The premium is the cost of the contract. Now, this is the only part that I'm going to say slowly. And again, should make sense, but I'm just going to say it really slowly so you guys grasp and understand. The cost that it's going to cost you to buy a contract. Okay. So you look at the premium of any puts or calls, whichever ticker. You find the middle ground between the bid and the ask. So let's even say this one right here, the 320 calls, right? 184, 189, roughly 186, right? 186.5, something like that. Well, whatever the premium price is, you times that by 100, and that's what it's going to cost you to buy one contract of that option contract. Okay. So if this is, let's say, $1.86 times 100, it would cost you $186 to buy one contract. Okay. If it was this one, okay, where we say it's $3, well, $3 times 100 would be $300 to buy one contract of the 317.5 calls. Let's go over to the puts. Okay, you see 2.01, 2.10. Let's call it 2.06. Okay, 2.06 times 100 would be $206 to buy one contract. Okay, now you may be asking, well, why times 100? And this is where I really don't want to get confusing, because we did a great job of illustrating what option contracts are versus what stock shares or equity is. But essentially, the way that it works is when you buy an option contract, okay, they are essentially saying, hey, we're going to treat the price that you buy as if you owned 100 shares, right? So if we go back to Google, okay, again, you don't need to know this, what we're talking about. This is just for your knowledge base. If we look and say, okay, price is at $319. Well, at $319, right, if you bought puts, let's say, and it dropped to $318, okay, well, if you owned a share of Google at $319 and it dropped to $318, you're going to lose $1. But if you had 100 shares, okay, of Google at $318, that means you would own $31,000 of Google, okay, right here, $31,000 of Google shares. And then if it dropped to 318, or sorry, that was that. So 319. So 319 times 100 would be $31,900, okay, $31,900. And then if it dropped $1, you would lose $100, right? If you own 31,000. Does that make sense? So if you bought 100 shares of Google right here, and you own $31,900 of Google shares, and it dropped $1 on the stock, your position size, you would lose $100, right? So over here on our option chain, again, if we bought calls right here for, let's say, that amount, they're going to say, hey, we're going to allow it to move where if this moves $1, right, on those puts, if it moves $1, you can benefit as if you owned 100 shares. But we're just going to discount the price, so you don't have to spend $31,000 to make $100 on a $1 move. We'll let you buy it for $300, and if it moves $1 in the direction you want it to, you'll make $100. Okay, so that's the last time you'll ever have to think about it like that, but I want to explain it so you guys know why. So it's not just like, oh yeah, it's times 100 and I don't know why. Okay, so that is how options work. Okay, so any contract that you buy, right, it is going to be times 100. So let's do some math here. Okay, because I really want to make sure everyone understands. And this is the beauty of the mastermind. We can sit and we can just make sure everyone's on the same page. Okay, so right here, if this, let's say, was $10 a contract, okay, with the understanding of what we just taught, how much would it cost you to buy one $10 contract? If the premium was $10, yes, $1,000. It would cost you $1,000 to enter that trade. How about 27 cents? If it was 27 cents, right, was the premium, the difference between the bid and the ask, how much would it cost you? $27. See, I got some of you there. I got some of you. $27, right? Because 27 cents times 100 is only $27. Okay, let's do a few more. 84 cents. How much would this cost you to enter in at 84 cents? $84. And then the last one, let's call it $6. If the option contract was $6, how much would that cost you? $600. There we go. All right. Hardest part of probably the mastermind conceptually to understand, you guys now have. Option contracts, okay? So let's review. We have the expiration date, and which expiration date do we always select? Doesn't matter what day of the week, which expiration date do we always select? Yes, the Friday expiration, okay? So if it's Monday, April, whatever Monday was, we're still going to trade the 10th. And again, there's a lot of different variations, and we'll talk about that, but for now, it is always the weekly expiration contract, okay? Then when I say what the strike price, what's the strike price? What's the strike price of a contract? Like, what does that identify? Yeah, it's the contract name. Okay, where do we find that? Right smack dab in the middle. Strike, right? Right here. And then the premium. What is the premium of a contract? The option premium. What is the premium? Yep, the cost. That is the price of the contract. Exactly. And how do we identify the price of the contract? Difference between the bid and ask times what? It's a magic number. We times that by uno cero cero. I know that's not correct, but 100. You got it. Okay, so now here's the coolest part. Here's why trading and the way that we trade is so simple. Okay, as you can see, right? When we are during the market hour, so when the stock market is open, because right now we are still in the pre-market, so the stock market's open, okay, or the stock market is not open. These are not updating in real time. The second the stock market opens, okay, the second the stock market opens, the bid and the ask price starts changing. So it starts going up and it starts going down. So it's not just like a static price. It's always updating and changing depending on what the underlying stock, right, the stock that we are looking at is doing, okay? So if the stock, Google, is going up, then these call contract prices are going to be increasing in real time. If Google stock is going down, the put contracts will be dropping in value in real time, and you'll be able to see that, right? So how do we know which of these to select, right? Because there's a bunch of different contracts. It's like, well, that's great, Jeremy, but how do we know which one? Really, really quite simple, okay? So when you actually look and you see how we have these blue, we've talked about this for 15 masterminds. We believe this is kind of like a plum blue, as I think what we've landed on. The plum blue is what we've called it. It's a little purple, it's a little blue. We think plum blue. We like that, okay? So if you look at the stock, look where the price is on Google right now, okay? Right here, we can see the price is at what? $314.84. Well, interestingly enough, you look, 315, right where the stock price is, that's kind of where we see some contracts in black and some contracts in blue or plum blue, okay? So the very simplest way, if you ever want to play a call contract with the stocks that we trade, you find the first contract in the black on the call side, okay? So you look, plum blue, plum blue, plum blue, boom. Black, that means the 317.5 calls, okay? And the technical term is called one out of the money, and you can see it just updated. Now the 315 calls are the contract that's one out of the money. And what that means is, again, if price is below 315, right, then that means the next contract based on the stock price is 315. We always want to be buying a contract that is called one out of the money, okay, meaning one away from where the stock price actually is. And so it's going to be different on the flip side for the puts, right? And then again, you can see right here where price is at. It's actually right in between where we see the calls and the puts. The first one in the black, first one out of the money is the 315. So it truly doesn't matter. So we could go to any stock ticker. Let's go to Apple. And if I'm like, hey guys, I'm looking at Apple calls, you know now that you can just go straight to the Apple option chain. You find the expiration date that we always trade. Then you go, boom, right to this contract, because it's the first one in the black, first one out of the money. That would be the 260 calls, okay? Now, let's say we were looking at Meta. So Plum is in the money. It sure is. Let's say we're looking at Meta. Okay, and I said, okay, guys, we're looking at Meta puts. Well, you would go straight to the 622.5 puts, and these are the ones that we would be trading, right? Because it's the first one in the black. Simple as that. It never varies, never changes. It's always the first one in the black. I've been trading for 10 years. I only ever trade the contract that is the first one out of the money. There's a lot of reasons why that is as day traders, and we'll talk about that, but not today. Okay? For today, I just want you to know which contract we select. We good there? Again, we simplify it, right? Just, yep, first one in the black. That's what we're looking for. Okay? So now, guys, here's what's so unique and what's cool about these first 2 days. You now know, okay, I know the difference between trading options and buying equity or shares in a company, right? Just fundamentally, you know the difference. One, you're kind of betting on the day's performance of the stock, and you don't care if it goes up or down. You can bet against it, you can bet for it. If you buy a share in the company, you own it and you want it to do good over time. Okay. And then, cool. If you're looking at this, it's like, all right, for whatever reason, I believe we're going to drop. Google's going to drop in price. You now know the exact genetic makeup of the option contract. Ivan, I would highly regard not, or I would highly suggest not tattooing that on your body, but hey, whatever you want, my friend. So again, if we're looking for puts, great. We go to the April 10th expiration date. You got it. Strike price, we know we can identify the name because that's what the name is. The premium, you're going to know exactly how much that contract is going to cost. And then we know if we're looking to trade it, you're going to look at that first one in the black, first one out of the money, where the plum blue meets the black. Boom, that's the one that we're selecting. Okay. So now how to trade it, how to load it up, all this stuff we will teach, not today, right? There's a reason we're not teaching it today, because you guys don't need to be worrying about how to enter into this, because you don't even know what in the world you're doing yet. So we will get there. All right, guys. Well, that is the genetic DNA and makeup of an option premium, an option contract. Okay. Option premiums, the cost, strike price is the name, expiration date, we always are selecting the weekly one. Okay. You guys now know what calls and puts are. I think it's time to start getting into some technical analysis. What do you think? We feeling good, guys? Give me some thumbs up if we have understood what we have discussed up to this point. We following along? We good? Yeah. Let's go, baby. Let's go. All right. Here we go. Now, what are we looking at here? What in the world is all this, right? What are all these candles and everything else? Well, let's talk about it. Let's hide some of these things and look. Okay, so what we are looking at here, this is the stock price. Okay, we are looking at Google. And what we are looking at is the last 5 days of the stock price movement. Now, yesterday, just like we're talking about the colors, right? The black area here is stock market open to stock market close, which is 9:30 a.m. Eastern, 4 p.m. Eastern. Then you see these little perforated lines, right? So you can see like this morning. This morning, this perforated line, this is pre-market. And you can see that the price is kind of moving during pre-market. As people who trade options, we cannot enter or exit positions during the pre-market or during the aftermarket. Okay, so this was the aftermarket of yesterday. This is the pre-market of today. We can only enter during the New York session, which is when, right, the gray turns to black, right? As soon as we hit 7:30 a.m. Mountain Standard Time, boom, stock market opens. You can get in and out of your option contract positions. It'll update the prices, right? So that's clear there. This is for people who are buying and selling shares, right? That's what you see. So we don't actually trade during this time, but we will use the information we see during the pre-market and during the aftermarket to help us understand key levels and different areas that we're going to be trading. Okay, so that's that. Now, when we're looking at the day, so let's just look at yesterday on Google. Okay, we can see the actual day, right, starting at 7:30 Mountain Standard Time, going until 2 p.m. Mountain Standard Time. Okay. Most people, when they look at a stock chart and they think stock price, see this, right? Like this is your standard. You're looking at a stock price chart. It's just the line, right? You see the line showing where price goes. You see Google right off the bat dropped in price, and it bounced, went up, and it came back, boom, 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 right? This is what most people think of when they think of a stock price chart. What we use as day traders is what's called candlesticks. Okay, so again, you can see it's the exact same price, the exact same movement, but we use what's called candlesticks. Now, the reason we use these, we're going to talk about these here just in a second, is because they help tell a story. One thing that you guys are going to realize is the only way that we can identify where price is going to go, right? We don't have a crystal ball. We don't have a magic 8 ball. We don't have anything, right? The only thing we have is what has previously happened, okay? So what's the greatest indicator of what's to come? Looking at what has previously happened, right? That's a life lesson in and of itself. Because guess what? If you're looking to marry someone, if you're looking to date someone, if you're looking to hire someone at a job, what's the only thing you can do to get an idea of like who they are as a person? Well, you look at who they are now and you look at their past performance. Have they had 5 divorces before, right? Have they been fired from all their jobs previously? Or are they, right? Have they had long careers? Have they, made transitions on their own, right? Whatever the case may be. past performance is one of the greatest indicators of future results. Okay? Past performance is one of the greatest indicators of future results. I genuinely believe that. Can people change? Of course. Can things happen differently? Yes. Generally speaking, though, if someone is successful in life, if they start a new venture, good chance they're going to be successful. If someone's lazy and, you know, an asshole, I don't know, guess what? They're probably going to continue to be lazy and be an asshole. I mean, like that's just how life works, right? Most people don't really change. So, that's all we're doing is we are using past data in the stock market plus what we're seeing in the now to help identify probabilities of what's going to happen next. And so these candlesticks, okay, they are better than the lines at telling the story, right? Because we can actually see strength and weakness and different interactions with key levels, right? All these different elements that you'll be learning here. And that's why we use candlesticks. So there's two types of candlesticks. There are sell candles and there are buy candles. Buy candles, as you can probably imagine, are the green ones. Sell candles typically are red, but here they are blue. Okay, and why do we set ours up as blue? Well, when I first started learning, I was really into psychology of trading because I was just getting absolutely smoked, right? So I was like, there's no way it's because I don't know something. It's got to be my mental side of things. It's got to be the psychology. The more I've traded, the more I've realized psychology actually has nothing to do with it. It's like, yo, the psychology of trading is the hardest part. No, you just have a bad system. Because when you have a good system, you don't really have to worry about the psychology. You just follow the system, right? Like, truthfully. Yeah, the psychology of like discipline and patience. Yeah, but like, oh man, the psychology. It's like, no, you don't have a system. You have a bad system. It's like, yeah, you're going to drive yourself nuts, right? So, blue, I do agree with this still. What does the color red kind of exemplify? What is it? What are the feelings and emotions with the color red? Anger, kind of stress, impulse, just like I think of the movie Inside Out, right? Yeah, danger, stop, right? Inside Out red, when red happens, it's just like everything takes over, right? We don't want that. I don't want to be feeling that ever when I'm a day trader, right? I want to be Zen mode. I want to be, okay, here we go, right? We're good, we're cool, we're calm. So what's blue? Blue is more calm, peace, serenity, drop of water, right? Whatever, chill, exactly. So when I'm staring at blue as opposed to red all day, I believe my heart rate's down. I believe I make better decisions. Okay, that's a little Jeremyism there. That's why we have blue on the chart. So our blue candles are the sell candles, green candles are the buy candles. Okay, serenity now. Oh man, I'm going through Seinfeld again for the however many time. Absolutely love it. Okay, so here's how the candlesticks work. Okay, there are two elements to a candlestick. There is the candle body and the candle wick. Okay, a candle body is the actual bar that you see, right? The filled in bar, and the candle wicks are the long lines that you see protruding out of the candle body, right? So candle body, candle wick, candle body, candle wicks, candle body, candle wicks. Okay. Now, here's how it works. These candles that we are looking at, okay, are candles that appear in real time every 5 minutes. And how do we know that? Well, right up here on our chart, you can see that the time frame we are looking at is the 5-day, 5-minute. So just like the option contracts that we always are trading, the weekly expiration contracts, we are always trading on the 5-day, 5-minute chart. So that means that we see 5 days worth of data, and the candlesticks are, a new candlestick appears every 5 minutes. You can set it up to have 1 day, 1 minute, where you look at the 1 day chart and candlesticks appear every 1 minute. Look how stressful that is. You can say, hey, we want to look at what it is, 20 days worth of data and candles that appear every 1 hour, right? That might be helpful for long-term investing, kind of get an idea of what's going on. But as day traders, just like everything, you don't need to really understand the reason why right now, but we trade the 5-day, 5-minute chart because that is what's most relevant to the style and the way that we trade, which is getting in and out of positions relatively quickly within the same day, okay? So you can see that the candlesticks start appearing, right, pre-market, and you can see, we'll watch this candlestick right now. It's not moving very fast, but let's watch this candle that we're looking at right here, and you will be able to see that it will move, okay? It should start moving. Well, a new candle should be appearing here any second. So you can see candle appears. Again, pre-market's a bad example because again, it's very slow movement with just shares, but let's watch right here. If it goes up, it'll show as green, and if it goes down, it'll show as blue. So let's see what we're doing here, Google. Give me something. Give me a little movement, for heaven's sakes. I've got 60 people on a call with me. I'm going to need you to do something, right? It's like that meme where you're poking something. Do something. That's me right now. Come on. Move. Maybe it won't move. No one's interested in Google pre-market. Come on. Just give me something. I'm going to go to a different stock. There we go. Okay, so you see how price just went up? There you go. So it actually moves and updates in real time, okay? Obviously, it's a lot different in pre-market. During the market hours, it's moving very quickly all the time. So here's how it works, is that when a 5-minute candle closes, right? So this is 7:25, boom, 7:30 market opens. A new candle will open, okay, if, let's say the candle was green. Okay, so this 7:25 candle's green, boom, stock market opens, next candle opens right here. It's going to open right here at the top of the green candle body. Okay, it's going to open at the top of the green candle body. Now, you can see price opens here at the green candle body. Well, during this 5 minutes, price pushed up here on Google at one point, got all the way up to here, and then it came all the way back down, and then where price opened at, right, it started to drop below. So during this 5-minute candle, when it was pushing up right here, it was pushing up, and the candle was showing as a green bar. Just like we're seeing this blue bar, it was showing as a green bar, right? It was pushing up from where price had opened. But then, as it got here, it started to push down, and since it was not exceeding the high point here, that's where the wick starts to be created, right? And then the bar that we're seeing, the green bar, is becoming smaller, 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 smaller. And then once it hit here, as soon as price dropped below where the candle opened, now it's actually showing as a blue bar. So it would change from green to blue as soon as we drop below where price opened, right? And then it has that wick, obviously, because it's like, hey, this is where price got to. Boom, now it's pushing down. And then during the same 5-minute candle, price dropped all the way down to here, but then price bounced up a little bit, right? And started to kind of pull back from the low point, ultimately closing after those 5 minutes right here, which means that after 5 minutes, when a candle closes, if it's a blue candle, price is at the bottom of the blue candle body. So then when this next candle appears, boom, it's not opening at the top of the candle body, it's opening at the bottom of the candle body because it's a sell candle, right? So each candle, as it goes throughout the day, next candle appears, boom, okay? Price, you can see, barely pushed up a little bit, might have shown green for just a second, pushed all the way down to here. Buyers were like, nope, we want to push it up to here. And then ultimately, it closed right here after 5 minutes. Next candle appears at the bottom of that blue candle body, okay? So right here, price then pushes up. Again, you can see sellers are like, nope, we push it back down. Buyers push it back up a little bit, and then right here, boom, price closes at the bottom of this. Next candle appears right here, okay? Then it pushes down, pushes up, closes right here at the bottom of the top of the green candle body, okay? Does that make sense? How candles work as far as the price goes? And then you can see that's how it works throughout the entire day, okay? Any questions on that? Any questions on the candlestick movement? This is one of my least favorite things to explain, okay? This is one of my least favorite things to explain because it's hard. It's very hard to explain simply. So if I did not do a good job of explaining it simply, please let me know. Any questions regarding that? So again, if you see a green candle, you know that the stock price closed at 5 minutes, boom, next candle appears, price over here, right, is right at $317.98. If it drops down, boom, next candle appears, price is here at $315.91. Does that make sense? Speak now or forever hold your peace. We good with that? It should make sense. Cool. Alrighty. So as we look at this, now let's talk about this for a second. So how could that in reality tell us what's going on? Well, let's say, hey, we see that right here, pre-market, this level, okay, buyers pushed price up, But then pre-market sellers were like, nope, we don't want you to get above that level. And then as soon as the stock market opened, price pushed up again, came back down, and sellers were like, nope, we don't want that level. Well, now, do you think that this level here has some relevance? Do you think that this is something that could maybe give us some key, some clues as to maybe what might happen when price gets to this level, right? Yeah, for sure. How about down here when we say, hey, price came down to this level, it kind of rejected off this level, it didn't really look like buyers, or it didn't look like, yeah, buyers did not want price to get below this, right? We see a touch here, touch here, touch here. It's like, man, buyers really did not want price to get below this level, right? Did that help us? Well, maybe, because look what happens here. As soon as price got here again, what happened? Oh, okay. So now we're starting to see maybe there's some relevance there. Maybe that could help us, right? And again, anytime you are trading and you are trying to identify what's going on, the candlesticks are one element of telling the story. Okay. Think of what we do. You are essentially a detective, right? You are finding different elements at a crime scene. You are finding different fingerprints, blood spatter, a strand of hair. We are looking for anything that gives us, without a, what is it? Innocent until proven guilty. We are trying to find, overwhelming proof that they did it, or that buyers are in control, or that sellers are in control. That's all we're doing. And so that is one piece of how you as a detective, of how you as someone in the stock market can help start to see what's going on with price or candlesticks. So now, as we continue to learn, okay, there are actually different patterns that we see in the stock market that can help us know what's going on, okay? One that we see right here is called a piercing line, okay? So this is when you learn. When you see this pattern interacting with key levels, there's a good chance that you're going to get a reversal. And sure enough, what do we get? We get the reversal. Same thing with this pattern. This is called an engulfing pattern, okay? And when you see this pattern, good chance you're going to get a reversal, which is exactly what we get, right? And there's so many different patterns that you can recognize. So we're going to teach you, I think we're going to go over 4. We had 6. We're trying to really minimize it even more. We're going to go over 4 patterns that we trade and look for here at Uncommon Education Trading that can help you identify which way stock's going to go. Again, we are not going to be talking about that right now, but we will address that at a later time. So again, now you know how candlesticks work, right? So now when you're looking at this chart, you can say, oh, okay, I know what's going on, right? So again, if you're like, yeah, from here, price opened here, dropped to here, opened here, dropped to here, opened here, dropped to here, opened here, went up to here, opened here, went up to here, opened here, went up to here, kind of didn't do anything, kind of didn't do anything, went up to here, went up to here, went down to here, right? You can see now how that works. So now let's introduce a few more elements of what we're looking at here at the charts of ways to identify what's going on, okay? The easiest one that we can talk about right now is support and resistance. So what is support and resistance? Well, support and resistance, you guys, simply put, is areas where sellers said, nope, we don't want price to keep going higher, and an area where buyers are like, nope, we don't want price to go any lower. So think of it as the roof above your head, that's the resistance, and the floor below your feet, that is the support. Okay? Support is the nearest support level below you, right? It's supporting you. Resistance, you're trying to jump up past a certain point, you're going to hit your head on a wall, that's the resistance. Okay? That's what support and resistance is. So at Uncommon, we make it pretty simple. There are 4 key levels that we trade off of support and resistance wise, because if you were to look and say, okay, let's try to find support and resistance, okay? Well, technically, this was a support for a moment because you can see buyers were holding it, right? And then it broke below. This was a support, and then you can see this is a resistance, and then this was a support, and then this was also a support. This is a resistance, and the next thing you know, you're like, oh my gosh, what am I looking at? I've got like 19 lines on my chart, right? It's like, yeah, good luck trading this. We don't want to do that, right? So we keep it super clean and simple at Uncommon Education, and we actually provide you with an indicator that automatically plots the levels for you, so you don't even have to stress about it. Okay, so there's 4 key levels that we trade off of, and they are quite simply the previous day high and low and the pre-market high and low. Okay, so what that means is pre-market high and low, you can see on this day, and let's do this so we can see here, boom. All right, so pre-market high and low. This was the pre-market high, right? The very top of this green candle here, that's the pre-market high. And how do we know that? Well, you look at pre-market from here to here. What's the highest point right there? Cool. That is the pre-market high. We then go to the pre-market low, which you can see from pre-market as soon as it started. The lowest point was right here, right? And so you can see, boom, there's the pre-market low right there, okay? So we can see, look what happens when price interacts with these levels, okay? Price pushed up to this resistance, and what happened? When price touched this resistance level, this area where sellers had shown us previously that they didn't want price to go above, what happened when price got to this level? It rejected off of it, right? Rejecting off of the resistance, bouncing off support, right? So yeah, we can see it rejected, right? Price went up and then very quickly was like, oh, no, you don't. We don't like that. Boom. And then same down here, right? When price got down to that pre-market low, what happened? It tried to go below, right? And then ultimately kind of figured itself out and then bounced off that level, right? So now you might be thinking, huh, okay. Well, now if I can identify certain candlestick patterns, right? And I can see that when price interacts with key levels, that sometimes that gives an even greater idea, like right here. If we see that this candlestick pattern resembles a hammer candle pattern, which we will talk about, okay? Hammer candle pattern is something like this, where you have the long wick below, small candle body. It kind of makes that arrow look, right, of pointing up. Well, if you see, okay, price interacts with a support level, which means, hey, you drop a ball and it lands on the floor, what's it going to do? Bouncy ball off the floor, what is it going to do? What's it going to do, guys? It's going to bounce, right? Am I crazy? You throw a bouncy ball, it hits the floor, what's it going to do? It's going to bounce, right? Well, guess what happens? Price comes down, price tries its best to push below, quickly bounces right back up, gives us a candlestick pattern that is somewhat of a reversal candlestick pattern where it's like, huh, well, maybe this might just be a good place for calls. Well, it would have been, right? So now you can see, okay, well, when we identify key levels, support and resistance with candlesticks, maybe we can start to identify what's going on a stock. I wish that, obviously the previous day high and low were irrelevant on this day because we had such a massive gap up, but this is how it normally would look, right? On a normal day, you're going to be seeing something like this, where you have the previous day high right here, right? You can see from the previous day. Yes, you can see the high right here, or here's another good example right here. Cool. So we can see, all right, so we've got the previous day high up here, got the pre-market low, previous day low, pre-market high, and look what happens, right? You get a break above that previous day low, gets above, get a break above that pre-market high, right? So if it's like, hey, that resistance, okay, well, sellers didn't even try to stop buyers here. It's like buyers just took control. Well, now that resistance doesn't really matter all that much anymore, right? It's like shooting a rocket through your ceiling, right? It's like with enough momentum, it will bust through the resistance and just keep going, right? And sure enough, boom, it just keeps going past, right? So point being is those are the 4 key levels that we trade, okay? Previous day high low, pre-market high low. Obviously, there are different levels that we trade, but those are the 4 key levels. And for me personally, those are really the only levels that I try to trade off of. They are relevant to day traders. They are strong levels, meaning they typically do hold well, or if they break, they have break move up. You don't need to worry about that yet, Angel. We will get to that later next week after our free week concludes. This is where we'll be going over everything, okay? But this is what's cool is these indicators, you just throw it into your chart and it automatically plots them for you. Super cool. So that's what support and resistance is, okay? And there's a lot of different types of support and resistance, but what we do and what we use is we are utilizing the pre-market high and low and the previous day high low for our support and resistance levels. So now, again, if we're trying to identify the murderer, if we're trying to figure out who did it, who done it, who's in control, buyers or sellers, now we have 2 different ways to identify what's going on, right? Key levels and what happens at those key levels, plus candlesticks and some patterns that you'll learn and identifying that. That is 2 of about 5 different ways that we're going to teach you how to identify what's going on in the stock market. So here's what's so cool, guys, for everyone who's here with me, okay? Tomorrow, what we're going to be going over is identifying trends, okay? kind of a trend of a stock. You've probably heard that term. We're also going to be talking about what these lines are here, okay? The pink and blue lines. We're going to be talking about what these are here. And then we're going to be talking about volume, okay? So those are the elements of what we use to help us understand what's going on any particular stock, right? Key levels, candlesticks, moving averages, volume, and then what was in there? Fifth one? Candlesticks, key levels. Oh yeah, and then trend. Okay, and then the trend. Okay. So then after we learn each element individually, just like today, you learn candlesticks individually, we learn support and resistance individually. Tomorrow, when we teach everything else, then guess what? Monday of next week, we put them all together, and that's what our strategies are. So on Monday of next week, you'll know what each individual element does and why it's important to know and how it can help identify things. And then we all kind of merge them together into beautiful, simple, easy to see, easy to identify setups that constitute the strategies here on Uncommon Education Trading. How cool is that? I love it because it's not this is not nonsense, right? Some traders are like, "Oh yeah, so you use this AI driven, whatever, and it spits out the color green, you buy it, right? Or this one stock, it's a penny stock, it's going to be the next greatest thing in robotics." Yeah, no, we are reading the market. We're professionals here. We're not messing around. This isn't a hobby. This ain't no hobby, folks. In the words of Kevin Kisner, this ain't no hobby. You are learning to read the stock market like a hedge fund manager. You're learning to read the stock market like a professional day trader based on data. It's not based on guesswork. This is literally based on facts, on data. And what's fun is when we put them all together in the strategies next week, guys, next week is when things go bonkers. Okay, so if you're here for the free week and you want to take part in that, right? Again, we'll probably allow a few of you to join us if you want to, right? For this mastermind, we aren't going to do another one for quite some time, but I'm telling you right now, next week is going to be nuts because we put all the strategy together. It becomes so plain and simple and easy to understand, and then it just comes down to great. Now, how do we execute the trades? How do we get in and out of these positions? We then do start talking about some of the psychology of trading when it comes to how to manage your account, position sizing, all these different elements. But for right now, you are learning the individual pieces individually because that will give you greater understanding. If I just taught you the strategy, it wouldn't be as meaningful and you wouldn't understand it as good as if I gave you kind of brick by brick how the house is being built. And so then when you look at the house, you know how to do everything. You know the framing, the concrete, the electrical, the plumbing, right? And again, that's what we're doing right now, okay? So I hope you guys are getting excited. It's going to be a blast. You learned a lot today, which is great. The rest of what the genetic makeup of an option contract is, the premium, the strike price, the expiration date. You learned about candlesticks. You learned about support and resistance. It truly is going to be fun. It's going to be fun the next few days. So tomorrow, we're going over trend. We're going over EMAs. And we are going over volume. Okay, those are the three elements we need to get through tomorrow. So with that being said, appreciate you guys being here. As always, if you have questions, if you need anything from me, please feel free to reach out. Let me know. If you are a part of this free week and you have interest in wanting to take part in the mastermind over the next 10 weeks in its entirety, shoot us a DM at Uncommon Education Trading or message me at Jeremy Lieber. And it's going to be a blast. Last question, I'm going to hop off. So are you watching the news and all that, or is it just reading? No, Ivan, I don't even look at the news. I don't even know what half these companies do, to be honest with you. That's not true. I know what they do, but I don't care. We're not looking at anything. It is all technical analysis. Because guess what? The news, pardon the French, I swear, so sue me, it's bullshit. It's just a bunch of nonsense, okay? Like, what's going on? By the time you hear about it, you're like 8 million hours too late. Right? The only way to successfully trade the market with consistency over time is by technical analysis because you are basing your decisions off of facts, not off of theory, right? Anytime you're guessing, I want no part in that, right? I want no part in that. That's why I only gamble at casinos on games that I feel like I can have a competitive edge, or at least I know what's going on, right? Blackjack, right? I love blackjack. It's data. It's probabilities. It's the same as this, right? Obviously, I'm not the house, so it's hard. With a good strategy in the stock market, you can be the house. Okay, you can. All right, guys. Well, appreciate you being here. If you guys need anything else, let me know. I'm going to hop off. Look forward to seeing you guys tomorrow. Again, if you do want more info, let me know. If you need additional help, let me know. But we are moving right along, and I appreciate you guys being here. So thanks for your time. Hope you had fun, and I will talk to you guys soon. Peace.